The Q1 earnings season is pretty much wrapped up now. Since our last podcast, Nvidia and the retailers have reported, but even before that, earnings growth was on pace to be at 26% year over year, the highest since 2021. Let's bring in our research director, Shiraz Mian, now to help recap things. Shiraz, Nvidia beat analyst expectations when they reported, but subsequent trading in the stock was muted. Why do you think that was?
So, NVIDIA has been truly a phenomenal performer this year, last few years. Stock is up 450%. Even those numbers seem almost fictitious, but it's it's more of sell the news type of a thing, Terry. There's not a whole lot of positive that still needs to be priced in the stock. They came out after the earnings release with this new offering for PCs. There's some buzz around that it's good and gives them an incremental upside in their operations. But on the whole, they are the leader in the space, the biggest market cap company, and the worry with investors always with a company like that is uh, when will the gravitational forces start acting on the stock? So there's nothing wrong with the results. There's nothing wrong with the outlook or its leadership status. It's just how phenomenal its gains have been that every now and then you see the stock taking a pause and settling down a bit.
The retailers have turned in a strong showing despite inflationary pressures and what some describe as cautious consumer spending. But in their earnings calls, it's been noted that retail CEOs had a bit of a somber tone. Did that concern you?
It does, and there is there is a number of these macro uncertainties that we keep reading about, keep hearing about. Uh, the, uh, the high gasoline prices and the effect that has on household financials and the broader purchasing power has been a recurring issue that has been exacerbated by this trend, and you hear that in commentary from the CEOs, and I think it's a legitimate worry that we need to keep an eye on. But as we all know, retail CEOs are experts in finding reasons on the horizon to temper expectations, to explain away why they may not be doing as well as the market was expecting. So, in that respect, it's not entirely surprising hearing it from them, but the worries are legit. I mean, we know there is extra stress on consumers, even though in the aggregate, spending trends remain still quite stable and positive.
So, would you describe CEO uncertainty in the retail group as high right now?
It is. It definitely is across the board. Even companies whose results were cheered by the market and were better than expected had a cautious and tentative tone in their outlook, and I think that's warranted by what's happening on the macro side. So uh, the picture on the whole remains stable. We are seeing as good household spending as we have become used to seeing in recent quarters. Uh, but at the same time, I think it's reasonable for us uh, to be cautious that segments of consumers are, relatively speaking, under more financial stress today than they were 3, 6, 9 months ago.
So, do you think that maybe while greater use of the buy now, pay later concept and tax refunds may have helped spending in Q1 for the retailers, may they also have masked any underlying consumer weakness?
So yes, those are reasonable uh, sources of support for continued consumer spending. We also have to keep in mind, Terry, that the labor market as a whole remains very strong. Discretionary spending has been held up by a strong labor market and steady earnings growth. And on top of that, these factors, particularly the relatively higher refunds, and then the availability of these newer credit facilities, those have all have helped. But the points of stress are also real, and that's the interplay of those two that's driving the caution and some sources of uncertainty.
Overall, then, were the retail earnings for Q1 pretty much on target, no pun intended, or better?
On the whole, I would say slightly better than expected. Some of the leaders, obviously, the expectations for them are always are strong, and it's at times hard for them to beat. Many others have been beleaguered, and like you mentioned and noted in your pun, have been beaten down enough that even modest signs of improvement help them stand out. On the whole, though, results are as good as could be expected, given the overall consumer spending environment that we are become used to seeing in recent quarters.
Who were the retail standouts?
So it's a mixed bag. I would say uh, Walmart had a pretty good showing, even though the market wasn't particularly impressed. And I think the same reason that we cited in the case of Nvidia can be brought back in the case of Walmart as well. It's been a standout performer. Um, Not just this year, but the last few years, was briefly over $1 trillion in market cap, still uh, within the close proximity of that kind of psychological high level. So there were some points that has investors pull back a bit from Walmart, but I think on the whole, all the positives that have been consistently cited in Walmart's story, consistent top line growth, very good execution, a very impressive e-commerce offering that is not only opening up new growth avenues for them, but also helping them attract higher income households and gain market share in that. In terms of the standout results, Dollar Tree was very good. The stock was up big on the news. Best Buy had very good results. The stock was up big on the news. Uh, and unlike Walmart, I would say uh, the very strong positive reaction to the Dollar Tree and the Best Buy was more a function of how beaten down expectations for these companies had been. Um, as you were discussing earlier, in the context of points of stressors in the consumer economy, we all intuitively understand that the likes of Dollar Tree, the likes of Dollar General, their customer base is at the core of those points of stress in the economy. So for them to come out with modestly better than expected results, to say something positive about the outlook, really cheered the market. So these two stood out in terms of the market reaction, but I think Walmart stood out for continued momentum on all the positives that have driven the stock over the last few years.
All right, let's recap the overall scorecard.
So, as you noted at the top, Terry, we are practically done with the Q1 earnings season. We have 492 companies of the S&P 500 that have reported already. Earnings are up 25.8%. Revenues are up 11.6%. 80.7% of these companies are beating EPS estimates, and 79.7% are beating revenue estimates. Any way you look at these, this was an impressive showing, and we saw the market react to those results.
So we've already topped that 26% year over year that I mentioned at the beginning?
So it's right in that vicinity. The final tally could move up or down a percentage point, but you're absolutely right. We are in record territory, both in terms of the growth rate for many years and the actual dollar amount. The dollar amount of earnings in Q1 is a new all-time quarterly record.
All right, so let's move on to the second quarter of this year. Q2 earnings. What story do you think it's going to tell for both retail and in general?
So one positive trend that we have been spotlighting over the last few quarters is the favorable revisions trend, and as you know, Terry, keeping track of the revisions trend is a core point of our research and our rating system, and we keep a very close eye on it. So the fact that before the start of the Q1 earnings season, we saw estimates nudge up. We see something similar at play for Q2 since the start of the quarter in April. We have seen estimates steadily go up. And over the past year or so, the tech sector has been a consistent, notable presence in these positive revision stories. It's slightly expanding beyond that. The energy sector has become a major contributor to positive estimate revisions as well. We are seeing that with basic materials, utilities, and a couple of other sectors as well. So the key takeaway from the Q1 earnings seasons for Q2 and for the rest of the year is this improving earnings outlook. Despite this macro uncertainty that we were discussing earlier, the overall aggregate profitability picture is not only strong, but is on the margin improving. And that's a key positive for the market as a whole, for the stock market.
Okay. And we want to remind our listeners, as always, that they can keep up to date on your latest earnings commentary just by accessing it right off the homepage at Zacks.com. With Shiraz Mian recapping the Q1 2026 earnings season, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.